The screen goes black. Trading desks fall silent. It's Tuesday, January 20th, 2026. Silver flashes at $955 per ounce. Gold sits steady at $4,738.50. Between these two numbers lives a ratio that has predicted every major financial crisis for the last 300 years. Right now, that ratio is screaming at 49.8 to 1, just under 50 ounces of silver to buy 1 ounce of gold. To most people, this is just math. To those who understand monetary history, this is a 5-alarm fire. You're standing at a crossroads that has appeared only a handful of times in human civilization. The last time this ratio compressed this far, empires fell, currencies died, wealth transferred from the careless to the prepared. Today, we're going to decode exactly what this ratio is telling us, why it matters more than the nominal price, and what comes next. Because if you think $95 for silver is expensive, you have calibrated your expectations to a world that no longer exists. We need to go back not to last week, not to last year, but to 1693. For over 200 years, from the late 17th century until 1913, the gold-to-silver ratio was fixed by law. It was not a market price, it was a mandate. 15 ounces of silver equaled 1 ounce of gold, 15 to 1. This was not arbitrary, this was the foundation of the global monetary system. Sir Isaac Newton himself set this ratio as master of the mint. The Roman Empire before him respected it. This ratio was as fundamental to commerce as the calendar or the measurement of time. It represented the natural equilibrium between two forms of money that humanity had agreed upon for millennia. Then came 1913. The Federal Reserve was created. The monetary anchor was cut loose, and for the next century, the ratio became a seismographer of financial stress. Every time the system approached collapse, the ratio moved. Every time governments printed too much currency, the ratio compressed. Every time trust evaporated, silver closed the gap with gold. Look at 1940. The ratio hit 100 to 1. The world was at war. Currencies were being debased to fund military spending. Gold became the ultimate refuge, while silver was abandoned. Then the pendulum swung violently. By 1980, during the Hunt brothers' silver squeeze, the ratio collapsed to 17 to 1. Silver became money again. It became speculation. It became fear. The ratio told the story before the headlines ever could. Fast forward to 1991, the ratio spiked back to 91 to 1 as the Soviet Union collapsed, financial systems restructured, and banks failed worldwide. Gold surged while silver lagged. These were not random fluctuations. These were crisis indicators. Every spike in the ratio corresponded to a breakdown in confidence. Every compression corresponded to a flight into tangible value. The ratio is not a relic of the past. It is a thermometer of the present. And right now, on this Tuesday in late January 2026, that thermometer reads 49.8 to 1. That is not normal. That is not stable. That is the sound of the system cracking. Here's what most analysts won't tell you. The ratio isn't just falling because silver is rising. It's falling because gold is running out of room to absorb the monetary chaos. Gold has already broken every record. Central banks have bid it up relentlessly. Sovereign wealth funds have accumulated aggressively. Institutions that know the dollar is dying have loaded up. But gold is expensive. At $4,738 per ounce, the entry barrier is high. Retail buyers cannot afford it. Small investors are priced out. So where does the money go? It flows into silver. And when that flow accelerates, the ratio compresses. This is not speculation. This is mathematics. This is liquidity seeking the path of least resistance. Silver is the pressure relief valve for a system running too hot. We're sitting at a critical support level right now. In 2011, during the last major precious metals rally, the ratio broke below 50 to 1 and touched 30 to 1 before the market peaked. That was the warning sign. When the ratio compresses below 50, it means the market is pricing in systemic risk. It means investors no longer trust paper assets. It means the rush into physical metals has begun. We have already broken below 50 at 49.8 to 1. The next stop isn't 45 to 1. The next stop is 30 to 1. And at 30 to 1, with gold at today's price, silver would need to trade at $157.95 per ounce. Not in a decade, not in 5 years, in the next 6 to 12 months. But the ratio can also reverse, and this keeps people awake at night. If fear shifts exclusively back to gold, if the financial system enters a deflationary shock, the ratio could spike above 100 to 1. This happened in 2020 when the pandemic hit. Liquidity froze, gold spiked, silver crashed. The ratio exploded to 120 to 1, the widest gap in modern history. But here's the critical difference between 2020 and today. Back then, the crisis was unexpected. The world had no preparation. Today, the crisis is structural. The debt is exponential. The currency debasement is intentional. The geopolitical fractures widen daily. This isn't a black swan event. This is the finale of a 50-year fiat experiment. In that environment, the ratio doesn't spike. It compresses. Because when the end game arrives, both metals rise, but silver rises faster. Let's talk about what the ratio tells us about true value. $95 for silver sounds expensive if you're anchored to $20 silver from a decade ago. But value is relative. Value is comparison. The gold to silver ratio is the most honest comparison we have. If silver trades at nearly 50 times less than gold, but is 8 times more abundant in the Earth's crust, then silver is structurally undervalued by a factor of 6. If silver powers solar panels, electric vehicles, batteries, and electronics at rates gold never will, then industrial demand creates additional scarcity gold doesn't face. If silver gets consumed and destroyed in manufacturing while gold sits untouched in vaults, then supply dynamics favor silver long term. The ratio tells you silver is cheap, not in dollars, but in ounces. You can trade just under 50 ounces of silver for 1 ounce of gold today. Historically, you needed only 15. That's a 35-ounce gap. That's your opportunity. Now let's bring in the Weimar Republic, because this is where it gets terrifying. In Weimar hyperinflation from 1919 to 2023, the gold-to-silver ratio started at 15 to 1. It dropped to 11 to 1 as both metals surged against the collapsing mark. By 1921, it widened to 40 to 1, then tightened to 25 to 1. At hyperinflation's peak, it exploded to 100 to 1. Why? Gold became the ultimate store of value. Silver handled daily transactions. People needed it to buy bread. They needed gold for generational wealth. The ratio tracked desperation. In currency collapse's early stages, silver outperforms because it's accessible, barterable, liquid for small purchases. But in the final stage, when currency becomes completely worthless, gold becomes the anchor. The ratio widens as gold gets hoarded and silver gets spent. We're not in Weimar's final stage yet. We're in the early stage. The ratio compressing at 49.8 to 1 confirms this. Let's compare today's environment to 1980. The Hunt brothers used leverage to corner the silver market. They bought futures on margin, pure speculation. When the Fed hiked rates to 20%, borrowing costs crushed them. Margin calls forced liquidation. Silver collapsed from $50 to $10. The ratio spiked because silver ran on leverage, not fundamentals. Today, leverage works the opposite way. Short positions in silver are massive. The paper-to-physical ratio hits several hundred to 1. More claims exist on silver than silver exists. When that leverage unwinds, it doesn't happen slowly. It happens violently. The ratio won't spike in a short squeeze. It compresses because today's buyers aren't speculators. They're industries, sovereign nations, central banks diversifying from dollars. You can't margin call a solar panel factory. You can't force China to liquidate strategic reserves. Here's the data you must internalize. From 1693 to 1913, the ratio held 15 to 1 for 220 years. That's the historical norm. Since 1913, it averaged about 60 to 1. Why the difference? Silver got demonetized, removed from coinage, turned industrial. Monetary demand vanished, but now monetary demand returns. Countries reject the dollar. Russia, India accumulate silver reserves. If silver remonetizes even partially, the ratio reverts toward 15 to 1. With gold at $4,738 and ratio at 15 to 1, silver hits $315.90 per ounce. That's not fantasy, that's mean reversion. Can the ratio keep falling? Can silver really outperform gold from here? It depends on supply. Gold supply stays stable. Mines produce predictably. Recycling flows steadily. Above-ground gold grows slowly. Silver differs completely. Mine production plateaued. Easy deposits vanished. Recycling proves near impossible. Silver disappears into microscopic electronics quantities. 1980 above-ground stockpiles got liquidated. No buffer exists. No release valve. When demand surges, price becomes the only variable. And when price is the only variable, price goes parabolic. This sets up ratio compression, making 2011 look like a warm-up. What happens if the ratio reverses? If geopolitical tensions spark hot war? If major banks collapse? If bonds seize? Gold could spike faster than silver. Ratio widens temporarily, but that widening becomes your gift. Swap opportunity at better rates. Long-term trajectory stays clear. System moves to hard assets. Fiat regime ends. Transition compresses the ratio. 15 to 1 becomes destination. 49.8 to 1 marks the rest stop. Professional traders use the ratio to move between metals without touching fiat. Wide ratio, sell gold, buy silver. Narrow ratio, sell silver, buy gold. They accumulate ounces, not dollars. Dynastic wealth preserves this way. Success equals ounces controlled, not dollars earned. Buy 1 gold ounce at 80 to 1 ratio, trade for 80 silver ounces. Ratio compresses to 40 to 1, those 80 silver ounces buy 2 gold ounces. Doubled gold holdings, $0 spent. Ratio becomes scoreboard. This is the game. Psychological trap catches most. $995 silver looks expensive. $4,738 gold looks insane. Expensive compared to what? Dollar lost 98% value since Fed creation. Dollar distorts. Silver and gold remain constants. Measuring silver against gold removes fiat illusion, reveals truth. Silver stays historically cheap relative to gold. Ratio brings truth into focus. Examine next 12 months. Ratio compresses to 40 to 1 by 2026 end. Gold flat at $4,738. Silver hits $118. Gold rises to $5,000, analyst consensus, ratio 40 to 1, silver $125. Ratio hits 30 to 1, 2011 precedent, $157 at current gold, $166 at $5,000 gold. Not moonshots, historical math applied to today. Ratio 20 to 1, gold $4,738 means silver $236. $5,000 gold, $294. Gold $10,000, bond collapse scenario, silver $588 at 17 to 1. Pure arithmetic, lever gets pulled. Warning, ratio stays irrational longer than you stay solvent. No leverage, no margin, no farm bets on timelines. Strategic tool for patient capital. Destination certain, path volatile. Don't trade ratio, position for ratio. Accumulate silver when wide, hold as compresses, swap to gold at historic lows. Decade trade, not week trade. Ratio tells us today, early precious metals supercycle. Silver becomes gold leverage. Paper suppression fails. Industrial collides with monetary demand. Vaults drain. Next 16 to 18 months deliver volatility, explosion, history. Ratio lies never. Pure signal amid noise. Zoom out. Ignore daily price. Can 49.8 ounces silver buy 1 gold ounce? Yes. Should you swap? No. Ratio compresses. Silver buys more gold weekly. Richer in real terms, even if the dollar price stalls. Professionals understand. Public ignores. Ratio isn't indicator. Ratio is the indicator. Predicted every crisis. Survived regime changes. Outlasted empires. Now flashes red. 1971 slow motion collapse accelerates. Ratio becomes hourglass. Sand runs out.
Understanding ratio covers half battle. Other half, action at extremes. When swap, when hold, when walk. Winners know, losers guess. Ratio becomes roadmap. Destination, wealth preservation amid flames. 49.8 to 1 marks pivot, decision zone. History offers three outcomes. First, compresses to 30-1 or lower. Industrial overwhelms supply. Investment surges. Remonetization partial. Silver crushes gold. Second, range-bound 45 to 55-1. Consolidation, tandem rise, balanced fear. Both perform, leverage muted. Third, spikes 70+1. Deflation shock. Gold exclusive haven. Silver technical sell-off. Gold wins short-term. Long-term compresses. Most likely, first outcome. Silver structural deficit. Supply stagnant decades. Demand accelerates. Solar, EVs, military. Paper over-leveraged. Physical tight. Central banks diversify. Retail awakens. Fundamentals scream scarcity. Gold lacks scarcity profile. Supply steady. Demand monetary, not industrial. Price excludes retail. Silver becomes path of least resistance. Herd moves silver first. Violent compression follows. Build exit strategy. Never sell silver $100, $200. Ratio dictates. Framework 49.8-1. Hold, accumulate. Broken below 50 confirms. 40-1, watch closely. 30-1, swap 20% silver to gold. 20-1, swap another 30%. 15-1, swap everything. Why? 15-1 marks historical mean, unstable. Mania peaks, public arrives, top nears. Swap volatile industrial to stable monetary. Lock gains, speculation to preservation. Ratio stops 25-1, adjust. Profit half, keep half insurance. Guide, not guarantee. Probabilities skew compression. Fundamentals, technicals, history align. Timing, ratio zigzags, spikes, crashes, consolidates. 50-30-1, 6 months or 3 years, unknown. Direction known, down. Hold, accumulate dips, ignore noise. Watch ratio, not price. Below 45-1, acceleration begins. 40-1, mania starts. 30-1, end nears. Clock, countdown. Advanced play, dynamic ratio trading. Discipline required. Intraday spike, sell gold sliver, buy silver. Intraday compression, opposite. Arbitrage fluctuations, accumulate ounces both sides. Precision, liquidity, stomach. Most skip. Hold silver, wait swap zone. Experienced, dozens yearly opportunities. Never all in, never all out. Move between metals, accumulate always. Mean reversion speculation. Doomsday dollar collapse, hyperinflation, ratio irrelevant fiat terms. Bread $1,000, silver $10,000 ounce, gold $500,000. Ratio widens 100+1. Gold superior collapse store. Key, measure ounces pre-collapse. Ratio maximizes ounces. Front run hyperinflation. Overweight silver compression. Swap gold pre-final. Ride silver, peak swap. Preserve transition. Roadmap through chaos. Never do, sell 955 expensive. Ignore overbought analysts. Skip fear reversal sales. Emotional, nominal anchoring. Ratio screams silver cheap versus gold. Hold, move started. Override kills. Final truth, gold-silver ratio best precious metals tool. Removes fiat distortion, nominal emotion, pure relative value. Now screams silver. Compression confirms breakout. Early historic revaluation, 49.8-1 broken 50. Destination 30-1. Beyond 15-1 if fractures. Generational wealth, patient rewarded, legacy born. Tuesday, January 20th, 2026. $955 silver, $4,738 gold. Don't ask high, ask ratio signal. Tells hold, accumulate. Game begins. Trust signal, ignore noise. Ratio never lies. Markets reopen tomorrow. Volatility returns. Headlines scream. Ratio anchors. North Star, truth. Smoke clears, dust settles. History written. Ratio shows the way. Always has, always will.